is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of DeFi Decoded. I am Alex Tapscott here with Andrew Young. It is Thursday, September 19th at 10:30 a.m. and risk is back on. Crypto assets are moving higher this morning, as are equities across the board, but especially technology companies. The NASDAQ 100 index, for example, is up over 2.3%. And we're seeing names related to crypto, AI, and other high growth areas doing even better. Coinbase is up almost 7% as we have this conversation. This is all obviously on the back of yesterday's big rate cut, a jumbo rate cut that took some people by surprise. In the lead up to it, about 60% of economists polled thought that a 50 basis point cut was the likeliest outcome. So it was by no means a minority position, but still not fully baked in to markets, obviously, as we see things moving much, much higher here this morning. So, we're not going to talk at length about stocks and other asset classes, but we are going to talk a lot about crypto. Andrew, is this the end of the summer doldrums, and are we set to resume the bull market mode that we experienced earlier this year? What's going on?
Yeah, I think this is the start of the bull market. Again, we've been calling it for a while, so I think it's tough to say really, but we did finally get the sort of rate cut that we've been expecting, albeit a little bit delayed. Another thing that's interesting too is inflation came below expectations. It's now at 2.5%, and just based on the base effects, it should continue to trend down. I think we're looking at below 2.5% in the next couple of months, and so I think we're pretty clearly clearly we're in an easing cycle. I also think we're starting to see a little bit of labor cooling. Obviously, we had the huge revision downwards about I think about 1 million jobs that were effectively all overstated in the past 12 months as well. So that kind of caught a lot of people obviously off guard, made everyone realize that the labor market's cooling a lot faster. It's going to be interesting to see if we see sort of one of the big reasons why crypto markets as well as equity markets tanked in August was the differential between U.S. interest rates and Japanese interest rates. Which began sort of the unwinding of the carry trade, and so obviously this
explain that, Andrew. Just spend a moment on that, just for the folks who haven't been paying that much attention.
Yeah, we talked about it in our previous podcast, but effectively you could borrow money in Japanese yen because the interest rate in Japan is so low. I think it's 0.2.5% or just pretty much near zero. And essentially borrow in yen, sell the yen for US dollars, and buy treasuries. And then therefore you earn, the much higher yield on treasuries. And you're effectively short yen, long US dollar, as well as long treasuries, short, Japanese bonds. And what happened in August, obviously, was the Japan raised interest rates by about, I think, 15 basis points. And then obviously, people started to front run the fact that the Fed was doing this rate cut, and so the differential between on the carry trade was essentially starting to unwind, and that created some yen strength as well, which then further narrowed the differential, and left a lot of people sort of caught out in the middle, and so we started to see an unwinding of that trade, which effectively the unwinding of that trade is selling US dollars and US treasuries, and also US assets in general, because some people did the carry trade and didn't actually buy US treasuries. They bought high growth US stocks, things like Nvidia and Mag 7. So generally there was that unwind put a lot of pressure on crypto as well. Crypto is obviously a long tail, high growth asset, and so we started to see some liquidity get taken out of the market. Anyways, the moral of the story is it's going to be really interesting to see if we get those fears, because in the short term, that the impacts of that on global liquidity are much higher than the impacts of just lower rates, which sort of feed through to the economy over time. So it's going to be interesting to see if we get some sort of, like right now the market's obviously cheering the jumbo cut, but it does increase the likelihood that we'll start to see more of an unwind on this carry trade. So who knows? I mean, the Japanese central bank also came out and essentially said that they were like obviously very market dependent and not going to try to cause this huge decrease in global liquidity from helping unwind this trade. So maybe we have like maybe like a lot of those fears have essentially been allayed in the short term. But yeah, I mean, I think that's one of the things that Arthur Hayes, who we quote often here, has been pointing to. He actually I think a week ago came out with an interview saying, if they cut 50, we're going to have a nuclear financial crash, is what he said. He says the market's going to cheer the jumbo rate cut in the short term, but attention is going to rapidly shift back to the unwinding of the carry trade. So far, he's right on the first part. Let's see if he's right on the second part. I think either way, though, looking beyond like the next kind of short term 2 to 3 months, I think everything is sort of set for a huge boom in crypto in 2025. So what do you think about
So I guess just to summarize like the Hayes thesis. So basically it's like, yeah, rates are getting cut. That's usually good for stocks, because it means that you can earn less buying fixed income assets. So you should move down the risk chain into like equities, right? And there's lots of other reasons. That's one example. But what I guess the thesis is as well, at the same time, with rates lower in the U.S., with a rate cutting cycle in the U.S., rate hiking cycle in Japan, then what's going to happen is that the Japanese yen is going to strengthen relative to the U.S. dollar. And when that happens, all the debt, all the stuff, the money that people have borrowed in yen in U.S. dollar terms is actually going to increase in value, right? So in order to satisfy their debts, they're going to have to sell assets in order to do that. And that, in the medium long term is going to put pressure on those U.S. dollar denominated assets, right? Is that basically the idea behind this thesis?
Yeah, it's actually more in the short term. So the unwinding of the carry trade is more of a short-term downward spike in global liquidity, just because the unwinding trades can be vicious, right?
Yeah.
Because as more people, especially like one of the most crowded trades in the world right now is obviously this carry trade. And so like the unwinding of the trade also increases the differential even faster. So it leads to even more unwinding. And so you get this like rapid deleveraging. And the thing is it's not even just hedge funds who have like massively crowded into this trade. A lot of Japanese banks as well are in this trade. Like it's somewhere in like the hundreds of billions of dollars. It's kind of it's unclear how much, but so yeah, I mean, I think that's like part of the thesis. So even though like obviously cutting rates, obviously is pro liquidity in like the short, medium, and long term, the unwinding of the carry trade is massively deleveraging in the very short term, and can also have like a positive feedback cycle where the unwinding of the trade leads to even more unwinding. So you have sort of a positive feedback cycle.
I guess the question then is like what is the extent to which this is already unwound, right? Like we had a couple of massive, events this summer, especially in early August, which people blamed on the unwinding of this trade. And, the question is like, how much is left there? How much selling pressure will there be on US dollar denominated assets to cover carry trade shorts versus how much incremental buying will there be of the market for people who are now gaining confidence that a rate cut is going to lead to higher asset prices? It's a bit of a kind of a balance, right? I don't know what the actual data says, but the U.S. retail investor, institutions that are sitting on cash, like money market assets, for example, are at an all-time high. Now they're typically at an all-time high at all times, right? Because they're just all assets are sort of increasing, but $7 trillion of cash on the sidelines, if you like, that is, there, not all of it, but some of it probably on the margin will be redeployed into stocks. So again, I'm not crunched the numbers. I don't know if anybody has, if there's a good research note on this, but I do wonder that, this whole carry trade thing feels feels kind of like yesterday's news. I mean, this kind of stuff can rear its ugly head again, but I think the narrative is starting to shift. And I just feel like, yesterday was a bit of a spook on the news, but today this rally makes me feel like, it's got some legs, frankly. That's, I don't know, unscientific take on what's going on.
Yeah, I think another thing also we need to point out is this also gives a lot more cover for China to do a huge stimulus package, which I think China is trying to target 5% GDP growth. And in the second quarter, it was, I believe, like on an annualized pace of 4%. And a lot of people are coming out essentially saying that China's going to have to come out with a huge stimulus package if they want to hit their goals. And also just the fact that, at least for China, deflation seems like the bigger concern. And so a lot of people are sort of expecting some sort of like big stimulus package to come out of China in the next couple of months. At least that's like what a lot of commentators are sort of speculating, just based on how poorly China's doing, and as well as like how over indebted the whole system is. So I think that's something also to watch out. Previous gigantic China stimulus packages have historically also boosted crypto assets. So yeah, I mean that's also extremely pro liquidity, pro global liquidity, and I think a lot of, like, at the end of the day, Bitcoin is kind of like a measure of global liquidity. So if global liquidity is trending up and to the right, we're likely going to see Bitcoin trending up and to the right, and then eventually that should filter down to Ethereum as well as like the smaller altcoins. That's at least the hope.
Yeah.
So we'll see.
Well, let's turn to that, Andrew, because the thing that typically happens in these kinds of markets, right, as you pointed out, is that Bitcoin is the leader, and then as it increases in value, there is a wealth effect or recycling effect that happens where people take their gains in Bitcoin and put it into other stuff, right? And there's also fundamental reasons why people buy. This isn't all just one giant liquidity game, but in general, we have seen the way that there is a cyclical aspect to this. Now, in the first half of this year, what we saw was Bitcoin predictably started to increase in value, especially around the launch of ETFs. And the ETF buying helped to throw fuel on that fire. So the BTC to ETH ratio, had BTC strengthening against the second largest crypto asset. Then in the spring, we started to see things start to reverse a little bit. Bitcoin today is at 63, its high is 72 this cycle. So in crypto terms, it's barely off its all-time high, right? But we've seen it sort of trading in this range, 52 to 72, for probably 4 months. In the early part of the spring, Ether started to outperform relative to Bitcoin. And it looked as if we were experiencing that second phase of the cycle, where as Bitcoin's rally matures, you start to see other names participating in that. But that's not what happened. It was a bit of a head fake. The Ether ETFs came out this summer in the United States. Obviously, they've existed in Canada for a while. And we saw lots of inflows, but we saw more outflows from the Grayscale product. And, for people who want to deep dive on that, you have to refer back to earlier episodes because I'm not going to rehash it again. But basically, and that coincided with sort of a stalling of the rally in other risk assets, right? And then there was this, carry trade tantrum that happened in August. And the upshot of my whole spiel here is that the Bitcoin to Ether ratio is looking very terrible, right? I don't know what it is at the exact moment. People can refer to it in the show notes. We'll put it in there. But basically, Ether's relative strength to Bitcoin is incredibly weak. And so the question is that going to reverse? And is it going to reverse because of the issues that you've raised, or is it maybe not going to reverse because of other issues? Because right now, there is a kind of growing narrative on Twitter about ETH's viability, not viability, but sort of its attractiveness as an asset. And there seems to be a lot of haters. Now, typically, as an investor, if you were George Soros or something, if there's if everyone's moving one direction, there may be a contrarian point of view. The other way to think about it is if everyone's rushing to the exits, then maybe you want to jump on that bandwagon. But I just wonder, what is your view on what comes next here in terms of Ether specifically, but the general market for other crypto assets?
Yeah, I think I don't know. Like I've been wrong on this for the last 12 months, so I take everything I'm going to say with a grain of salt. But
You haven't been wrong. You've been early.
I've been early.
Yeah, you've been early.
I don't know. It's interesting.
Like,
in a lot of ways, this is shaping up to be the classic crypto cycle where Bitcoin leads and then everything else follows. We've seen a lot of pump fakes right now from Ether. I would say sentiment on Ethereum has never been lower in the 7 years that I've been in crypto. It's actually crazy how Ethereum's essentially become a punchline to every joke. If you're someone like me who lives on crypto Twitter, I think the major bear case for Ethereum right now is that Ethereum has hundreds of I think over 100 L2s now, but those L2s are actually parasitic to Ethereum in the sense that these are competing with Ethereum and not passing that much value back to Ethereum. Mostly,
what's with that? Because the whole idea was, the way you've described it is Ethereum sort of like what the Federal Reserve sort of clearing system, where it's like the final anchor for the whole financial system. But then there's all this transaction volume happening between banks and other financial institutions. But like the Fed is incredibly powerful, and so that was the narrative. It's just a metaphor. It doesn't have to follow it like a rule of science, but it was a very compelling metaphor. And I'm wondering, is that playing out?
Yeah. So I think there's a lot of confusion on this. So essentially, a couple months back, Ethereum introduced this thing called blobs, or that's at least what people call it. And essentially what it did is it massively lowered the cost of layer 2s to settle to Ethereum. So at the time, all these layer 2s were having a lot of competitive pressure with low cost networks like Solana and whatnot, because the cost of settling to Ethereum was so expensive. And essentially those costs are passed back to consumers. And so when you were using Arbitrum or, Optimism, it was costing, 30, 40, 50 cents to do a transaction. Whereas most sort of like Solana, it's a quarter of a penny or whatever, or even less, I think. And so essentially what happened was layer 2s were becoming uncompetitive because of the high cost of settling to Ethereum. And this was, effectively bullish Ethereum in some ways, because it meant there's more transaction fees generated on Ethereum. There's more value capture from L2s to Ethereum, but obviously coming at the cost of sort of competitiveness. So the blobs upgrade essentially just made it way cheaper to settle to Ethereum. And so that led to a massive 99% reduction in the cost of using these L2s, which has led to a surge in growth, both in terms of new L2s, but also surge of growth in terms of on the pre-existing L2s. So effectively what Ethereum did was hurt its value capture at the, but obviously to grow more. It's essentially a growth play, but a lot of Ethereum people, effectively that, plus also just the fact that more and more people are taking their assets and their activity off Ethereum onto other L2s. The combination of those two led to a huge reduction in transaction fees captured by Ethereum. So to me, though, that's very positive, because you know what I mean? It would have been, sure, it could have captured more value in the short term by, not doing the blobs upgrade, and L2s would have just been, wouldn't have grown as much as they have. I personally still think having hundreds of L2s that all settle to you is incredibly good long term, both for value creation but also value capture. And I also think what's interesting is we're starting to see people create L2s that are settling to a Solana as well, which is interesting because the whole point of Solana is to be a monolithic chain where you don't need to fragment liquidity by creating these. They call them network extensions in Solana parlance, but to me, that just kind of reinforces the fact that personally, I think the best way to scale is by having other networks that essentially settle to your main network, like you said, that FedWire analogy. And I also just think eventually they'll capture value from these L2s, but it's still so early. Like let's get the market first. So yeah, I mean, I guess to answer your question, it's the cannibalization of revenue from L2s. It's the migration of activity and transaction fees on Ethereum to these L2s, and just the sort of like skepticism in the crypto world that Ethereum will actually capture value from these L2s long term, which I think I disagree with, but we'll see.
Yeah, I think it's interesting because oftentimes in a new market, for whatever it is, the very first things off the production line are luxury products in a way, or they're expensive because the cost of production is very high. And that can be that's been true for automobiles. That was true for computers. It was true for lots of different things. And in a way, you can sort of think of Ethereum as this sort of early iteration of a blockchain network that became a victim of its own success because the fees were very high, because the technology wasn't sort of ready for prime time. Then they had all these big improvements in the underlying technology, which made it more performant. Now, if you think about like a car analogy, it's like Henry Ford created the Model T, and he was able to sell a car for $600 in money at the time. And so now all of a sudden, like lots of people could own cars. The cars themselves declined in price. So, the Ethereum analogy is the fees paid on transactions with blobs went down. But the gross number increased so much that the revenue for the automotive industry, the revenue for companies that mass produce things exploded. And so the most valuable companies became the ones that could do a lot of units of volume. So it's sort of like using this analogy, Ethereum has now become this assembly line, mass production sort of facility for block space for transactions because of L2s. And it has caused the unit price to go down per transaction, per, computation. But there's going to be a lot more of them, so revenue should increase. But we haven't seen the latter, right? That hasn't happened here. We haven't seen, it's like, there was 1,000 transactions at $100 a piece. Now there's 1 billion transactions at 50 cents a piece. That's still going to be a bigger number, right? But we haven't seen that yet. I don't know. Maybe that's the wrong. It's just again, we're trying to grasp at analogies and narratives to try and fit the current moment. But I guess we haven't seen that yet. And so people are like, wait, can something become better and more efficient, but become less valuable as a result? Like, I feel like that's the question that a lot of people are asking.
Yeah, to me, it's kind of like it's like the Uber play or whatever you want to call it. You know what I mean? Like, let's sacrifice short-term value capture for long-term market domination. And I think that's a really good strategy if there's network effects. I think that's a really good strategy if there's network effects to what you're capturing. And to me, there is huge network effects. So this is like a very pro-growth thing. Like if you're long-term greedy, I think this makes a lot of sense. Where it sort of breaks down is if there's like some skepticism around maybe you can't even capture this value long-term because you have other people trying to compete on data availability, like essentially trying to capture the settlement value away from Ethereum. I'm not sure about that. We'll see. There's also another argument that L1s aren't even it's L1. So like blockchain value capture is really actually just a race to zero. And the only thing that matters for L1s is monetary premium. So essentially don't even worry about doing a DCF on Ethereum. Don't even, there's no value capture for blockchains is nil. The value of Ethereum is going to come from the fact that it's used as a currency within this massive digital economy. So there's also the store of value people who are kind of which I don't even know if I agree with, but for me, coming from a TradFi background, that's sort of harder for me to wrap my head around. But if you believe in that argument, then having everything sell to Ethereum and increasing a lot of these L2s actually use Ethereum as their transaction token for these networks. That's actually the standard as well. So that also increases the moneyness of Ether, and that would be an incredibly bearish long-term thing for Solana. But we'll see. I mean, it's kind of weird because sorry, one last thing, because I'm trying to cope in real time with Ethereum's underperformance. But I don't really know why this isn't really this same like logic isn't applied to Solana, in the sense that Solana is losing hundreds of millions of dollars a year through effectively inflation to validators, which effectively subsidizes the extremely low cost of using the Solana blockchain. And so I don't really know why that Ethereum is sort of being like judged at this like higher level, and that's partly the fault of the Ethereum community, which has like promoted this narrative that Ethereum captures a ton of value. You can use a DCF to value it. It produces a real yield effectively. And so effectively, the Ethereum community promoted this real yield narrative, and then and now it's kind of gone. I would say it's somewhat shifted into like a pro-growth, pro-L2 narrative. And so part of it is just kind of getting hit on that. I don't know. We'll see. I think like we also just saw no bounce in Ethereum post ETF, which was pretty surprising to me, even though we've obviously been seeing inflows into the Ethereum products as well. I'm curious, like what your take is. Like what's
Yeah, sorry, I didn't mean to interrupt. Yeah, inflows into it, but outflows from the Grayscale Trust because the redemption window had opened up, right? And that has outweighed the inflows. That's just, I think that's a big part of the fund flow story. But that'll resolve itself, right? So the question then is, well, what about the fundamental case for ETH? And I'm not sure that, I'm bullish because I think, look, this is still the leading platform, and all of these L2s are built on Ethereum. Ethereum is where all the DeFi TVL is, or a lot of it. It's where a lot of innovation happens, where a lot of the smartest people are. Not all, but a lot. And so, taken as a whole, and it's been becoming more performant. Stable coins, the majority of stablecoin values settle on Ethereum or an L2. And I just think that's enough to be bullish. But I'd like to maybe drill down a bit more. I don't know. I'd love for you to write a 500-word thesis on Ethereum. I would love to see the bull and bear case laid out very, very clearly, as if it were a sell-side research report for, the broader public. Less of this mumbo jumbo. No offense, there's a lot of meaning I think that gets sort of lost in a lot of this crypto talk. I'd love to just sort of see look, here's the base case, the bear case, and the bull case for ETH. And that's based on different metrics, value capture, its moneyedness, its use as collateral, whatever, some sort of breakdown to show what actually should the target price of this thing be when you look at it on all these fundamentals. One of the criticisms that I get from time to time is that, crypto assets are just people don't use this term. They say it's sort of what's backing it, but they're highly reflexive, right? In the sense that as they get more as they grow in size, they become more valuable. When they grow in size and become more valuable, because size and liquidity and market cap are actually very important. But beyond that, what are the drivers of that? Are there any fundamental reasons for that? And I think, and obviously there are, but they're not, and they're discussed in these communities that I'm not sure reaches the broader public, right? I look at the marketing campaigns of a lot of the ETF issuers and how they're positioning ETH, and I think it's really useful to help introduce these ideas to people, but they're not really drilling down into an investment case the way I think you need if you really want to drive capital to something, to drive investors to something. So I don't know, maybe we should plan this. We've got a guest for next week, but I'd love to just sort of do an episode almost on the bull, bear, and base case for Ethereum. We should think of someone who can come on to talk with us about that. You're probably one of those people, but there are others I'm sure that could help us out.
Yeah, I think you actually brought up a really, really good point there too. Most of the activity and therefore transaction fee revenue from crypto networks is highly reflexive to the price of the underlying crypto asset. Exactly. In the sense that as the price of Ethereum goes up, that creates a lot more DeFi activity. That also creates more, that creates more tokens. That leads to a proliferation of more tokens, therefore more trading activity. And DEXs are one of the main apps on these networks. So it's highly, highly reflexive. We unfortunately haven't really broken into any what's called consumer crypto use cases. I'm obviously working on one of them in sports betting and sort of prediction market side, just because that essentially is one of those use cases that's independent of the actual crypto asset ecosystem. And we're starting to see some breakthroughs, but for the most part, the vast majority of activity on these crypto assets is reflexive to the crypto asset price, which is also hilarious because the crypto asset's price is obviously a reflection of all the activity happening on the networks. So like there's this positive feedback cycle where, asset price goes up, more activity, that creates more revenue, which then justifies an even higher asset price. And that's why you see these gigantic booms and gigantic busts. In a lot of ways, it's kind of like a commodity producer. You know what I mean? Like commodity producers, they always look cheapest on a PE ratio at the very top of the cycle. And so a lot of people kind of get into these like value traps where they buy commodity producers at the exact top of the market because that's like when they're producing the most, even though that's obviously like right when commodity prices are starting to collapse and there's the most amount of investment coming into the commodity market, and therefore there's a huge glut of supply. Whereas like at the bottom of the cycle, commodity producers look horrible on a value basis often because like they're losing money, production's down, even though that's actually the best time to invest because no one's been investing. Like gold mining is a great example of that, right? Like gold production is way down. If you look at something like Barrick Gold, the amount of gold they produce is down I think over 60-70% from its peak. And things look most dire, but at the same time, you're seeing not that much investment into the gold mining space. So anyway, moral of the story is crypto follows a very similar sort of cycle where the P ratios look best right at the worst time to invest. So maybe it's just one of those things.
It's true for gold miners. It's actually true for a lot of different asset classes. It's like, what were the forward earnings estimates for the S&P 500 companies in the bottom of COVID or in September of 2008? They had been slashed. No one had any idea where things were headed. So actually, like if you look at PE ratios, even for major indices, like during the great financial crisis, stocks look really expensive when actually they were at their cheapest, right? It's a classic, to your point, value trap. This has been a great chat, AY. I always love these sessions where you and I get to talk about the market and debate these issues. That's it for this week's episode of DeFi Decoded. Thanks everyone for tuning in. Make sure to like, share, comment on the show. It helps other people find it, and we appreciate it. Until next time, have a good one.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.